Hello and welcome to a brand new edition of Smart Money. Now, with the RBI hiking the repo rates at which banks borrow money, high inflation and tighter liquidity conditions have reduced the steepness of the yield curve. So this, according to many experts, is a good time to invest in fixed income as part of your portfolio. Attractive yields, a wide variety of schemes, and tax benefits for long-term holdings are just some of the benefits. Joining us today is Rahul Goswami, the CIO of Fixed Income at ICICI Prudential Mutual Fund. He, in fact, manages a fixed income portfolio, which I guess is by far the largest in the country. Rahul, thanks a lot for joining me on the show. I first want to start by understanding how the fixed income landscape has changed over the past 1 year, and then we'll come to whether it's a good investment opportunity for our viewers.
Thank you, Sonia, and thank you, CNBC, for calling ICICI Prudential. So what you said is absolutely correct that the things have changed pretty rapidly in last, say, 6 months, and especially if you compare it to last 1 year. After inflation spike persisted and the inflation no longer was seen to be like say temporary or for the time being, but the inflationary pressures have sustained and one or the other thing kept on going bad, and we have seen like say globally central banks raising rates aggressively, and RBI in fact has in last 6 months raised the policy repo rate by almost 190 basis points. And market yields have gone up sharply by almost 300 to 400 basis points as far as the very shorter end of the curve is concerned. On the on the fund side also, we have seen good participation coming up from investors who are now looking to benefit from higher interest rates. Could see RBI hiking policy rates and liquidity getting tighter, like say 3-month T-bill, which was yielding about a year back of close to 3.25%, is now yielding close to 6.4%. And that is the similar case with the bank CDs, where the 1-year CD rates have gone up by 300 to 325 basis points from say close to 4% levels to close to 7.5, 7.6% levels of the good high-grade AAA banks are concerned. So we are seeing renewed interest from the investors as they are also seeing that the portfolio yields have gone up across the curve, and that's what is consistent with our view what we were having for quite some time.
Okay. So Rahul, the portfolio, you're saying you're seeing a lot of keen interest from investors in the fixed income market, but I wanted to understand from you, has the rise in interest rates been proportionate across the yield curve, and which segment of the yield curve has, for example, been most impacted from the rate hikes?
So, Sonia, what has happened in, like, say, the 10-year bond yield, which was about, say, a year back of about close to 6.5%, that has gone up by almost 100 basis points, whereas the shorter end of the yield curve, which is directly or more meaningfully impacted by the RBI policy rate actions. So that the shorter end of the curve has moved up by 300 to 350 basis points in the up to 1 year maturity segment. And that has seen the biggest benefit coming from for the investors who are invested in the low duration category or very short-term maturity funds category. Apart from that, the investors who have benefited and have not lost money because of policy rate hikes are the investors who are invested in floating rate instruments. And as we understand, we believe that it is a extremely, rather not at all wise thing to borrow in a floating rate structure in a rising interest rate scenario, and in a scenario where inflation has turned out to be much more persistent and not temporary in the nature. And we expect that the floating rate investors and the low duration category investors or investors who are invested in low maturity funds are likely to benefit most in times to come, with interest rates more expected to rise in the near to medium term.
So you're saying that interest rates are going to rise further. Is that your expectation, or do you think that they've peaked already? Because there is a mid-quarter review, or rather an out-of-turn review of the RBI coming up next week, right, on the 3rd of November. But there's no rate hike expected there. And the view from across the globe as well is that in this FOMC US Fed meet that happens next week on the 1st of November, there could be a 75 basis points rate hike. But then post that, rate hikes perhaps have peaked. So from an investor standpoint, do you think we've peaked in terms of the maximum amount of rate hikes?
So, Sonia, what the market chatter and the market, the curve is pricing in is about say 150 to 175 basis points for the rate hike by US Fed in next say 2 to 4 months, or latest by March of 2023. And in light of that, apart from that, other central banks are also likely to have a different magnitude of rate, like say ECB raised rates by 75 basis point, and they have said it will be data dependent going forward. But in India, we see that with challenges such as elevated current account deficit and relatively high fiscal deficit of close to 6.5%. We believe there is possibility that inflation may remains higher than the RBI threshold level of 6% in next say 2 to 4 quarters. And in light of that, we believe there is possibility of 75 to 100 basis points for the rate increase in case of India as well in next say 1 or 2 quarters. But we cannot comment on what the 3rd of November, the out-of-turn RBI monetary policy that is being conducted, that primarily looks like is the MPC being called to discuss or deliberate the reply to the government, which was required that the inflation number has reached the RBI threshold level for last say 3 quarters consecutively.
So, okay, let's try and understand from a layman's point of view, right? For an investor who perhaps has never looked at the fixed income market, is now interested because of the way the interest rates are moving up. Why is the fixed income market attractive today, and why should I invest in it with, say, a few months or a year horizon?
Yeah, so if you compare it to the savings deposit rate, which is probably close to 3% for best of the banks in the country, and against that you get the very low risk category or very high credit risk and very low interest rate risk category funds, which can be as conservative as an overnight fund, which potentially would be yielding close to 6%, and the liquid fund, the money market funds, the ultra short category funds, and the low duration fund, where the YTMs have gone up beyond say 6.5% and even close to 7.5%, 7.25% to 7.5% for low duration and floating rate funds category. So I think there is a great merit in keeping money invested in mutual funds and try to take benefit of these elevated interest rates. What we believe is that the rates may remain elevated owing to uncertainty globally on account of whether be it Russia, Ukraine, or other things propping up or coming up, or that the inflation may remain close to 6% or higher than RBI threshold for India, with currency pressure continuing to persist in another say 4 to 6 quarters, if not more, owing to high current account deficit and high fiscal deficit numbers. So we believe that inflation may remain high, and we, in all certainty, will see probably 75 to 100 basis points further increase in the RBI policy rates. And we think that low duration funds and the floating rate funds and the very low maturity funds are likely to be great asset for investors instead of keeping money in a dormant account at very low rewarding rates.
Okay, all right. Well, let's do one thing. Now it's established that with interest rates going higher, fixed income as a part of your portfolio is perhaps a great idea. How much should you put into fixed income, and what are the different kind of fixed income opportunities that we have? We're going to talk about all of that on the other side of the break. Don't go anywhere. Smart Money will be back in just a bit.